when you're thinking about starting a business, or maybe just trying to understand the full picture of a country's tax system, you really have to dive deep past that headline corporate income rate.
Absolutely.
Today, we're doing exactly that, a deep dive into the specific compliance rules and the other taxes that are really essential for corporate operations in Bangladesh.
Yeah, that's spot on. Our mission today is really to give you let's say, a precise map of that whole complex terrain.
Okay.
We're definitely moving beyond the basic income tax stuff to unpack the detailed framework. So things like the value-added tax system, the VAT, mandatory withholding rules, that stack of import tariffs we hear about, and even some specific excise duties.
Right.
And we're drawing this from really authoritative sources, official tax summaries, technical advisory reports from major international firms like Deloitte, RSM.
Yeah, our sources are pretty solid. Those detailed analyses from Deloitte, RSM, they offer very practical technical guide. It seems like they cover everything from the main VAT and Supplementary Duty Act of 2012, right down to the specific monthly forms you actually need for filing. So if you, the listener, need a kind of shortcut to understanding the compliance environment for corporates in Bangladesh, well, you're in the right place. Okay, let's unpack this. And I guess we have to start with the big one, the cornerstone of indirect tax, value-added tax, or VAT.
Definitely. VAT is foundational there. It's a transaction-based tax brought in under the VAT and Supplementary Duty Act back in 2012.
Yep.
Now, the standard rate, that's 15% for most goods and services. But, the first challenge for any business is just navigating the sheer number of reduced rates.
Yeah, I was looking through the technical summaries, and it's frankly a bit dizzying. There's this whole range, 1.5%, 2.4%, 4.5%, 5%, 7.5%, and 10%.
Exactly.
So that means like a tiny change in how you classify your product could completely shift your profit margin, right?
Yeah.
It seems like you need extreme precision.
You absolutely do. And that connects straight into something called supplementary duty, or SD.
Ah, yes. SD.
Yeah, it's an additional levy on specific goods and services. And the rates there can go anywhere from 5% right up to, believe it or not, 65.5%.
Wow.
But the critical distinction, and this is key, is about when it's paid. VAT is payable at, each stage of the supply chain.
Right, standard VAT.
But SD, that's only payable once, usually at the first stage of supply. It often works kind of like a punitive tax or control mechanism on certain items like luxuries or perhaps goods they want to discourage.
Okay, that makes sense.
Yeah.
So if you're setting up shop there, when do you actually hit the point where you have to register for VAT? What's the threshold?
Good question. Mandatory VAT registration kicks in once your annual turnover goes over BDT 30 million.
30 million, okay.
But, and this is important, if your turnover is lower, say, between BDT 5 million and 30 million, you don't just get off scot-free.
Oh.
You fall under a different thing called turnover tax. You need an enlistment certificate for that. And you pay a separate tax, but at a lower rate of 4%.
Got it. So there's a sort of intermediary step. Now, let's talk about managing cash flow. Input tax credit, or ITC. This is huge, right? Being able to reclaim the VAT you paid on your inputs. Generally, what makes an expense eligible for ITC?
Okay, so generally ITC is eligible if your final output, your product or service, is taxed at that standard 15% rate. Or if you're exporting, because exports are zero rated.
Right.
But, and this is the critical nugget that our sources really hammer home for you, the list of non-eligible items is, well, it's massive. And this turns what you might expect to be recoverable tax into just a fixed operating cost.
Wait, I was reading through this list from the advisory reports, and it's not just luxuries, is it? You can't claim ITC on stuff related to passenger vehicles, entertainment, sure, but also club fees, land, buildings, even basic office equipment like furniture, ACs,
Right.
or things related to employee welfare and travel.
Yeah.
What's the thinking behind restricting it on such fundamental things?
Well, this sort of embedded rationale is partly about maybe discouraging consumption of certain things, but honestly, it's primarily about minimizing tax leakage and just ensuring revenue for the state. It's a revenue protection measure.
Right.
By making ITC non-eligible on core infrastructure, on those basic setup costs, the government basically locks in that 15% VAT right away. It fundamentally changes how you have to budget for just setting up a basic business.
That's a huge operational detail, like really hidden. It shows exactly why you need to look past the headline rates.
It really does. And that detail connects directly to another system, the mandatory VAT deduction at source, or VDS.
VDS, okay, what's that about? about?
This system basically forces specific large entities, they call them VAT withholding entities, to act as the tax collector when they buy certain services.
Right. And who falls into that withholding category? Is it everyone?
No, it's a defined list, but it's broad. It includes all government entities, NGOs, banks, limited companies, and basically any corporate entity whose turnover is over BDT 100 million.
Okay. So larger players.
Exactly. When these entities buy specific services, they have to withhold the VAT amount and pay it directly to the government.
Ah, so the onus is on the buyer.
Precisely. For instance, if they hire legal advisors or use an ad agency, the VDS rate is 15%. For others, like construction contractors or maybe non-AC hotels, it's lower, say 7.5%. The buyer, not the service provider, is responsible for remitting that tax.
Wow, that must significantly increase the admin burden on those large companies. They have to track all these different rates and services.
It absolutely does. It's a major compliance task for them.
Okay, let's switch gears slightly now to corporate income tax, CIT, just briefly. We know the rates vary. I think it's around 20% for some publicly traded companies, 27.5% for many others, and can go up to 40% for banks, right?
That's broadly correct, yes. Different rates for different types of companies.
But what really jumped out at me from the sources, and this feels like a crucial insight, especially for maybe an international investor, is the minimum tax rule.
Oh, yes. This is a really non-negotiable feature of the landscape there.
Mhm.
Basically, if a company makes a loss or if the tax calculated on its net income ends up being extremely low,
Mhm.
well, the minimum tax rule kicks in anyway.
How does that work?
This minimum is calculated as 0.6% of the company's total turnover or gross receipts.
Wait, 0.6% of turnover, not profit.
Correct, turnover, gross receipts.
That's fascinating. So the government is essentially guaranteeing itself a slice of every single BDT that flows through the economy via that company.
Pretty much, yes.
So if you generate, say, BDT 100 million in gross revenue, the government gets BDT 600,000, even if you, the business owner, didn't actually make a single taka of profit.
That's exactly how it works.
That completely changes how you'd calculate risk, especially in the early startup phase.
It really does. It ensures a base revenue flow for the state no matter what. And this combined complexity, the different CIT rates, the mandatory VDS withholding we talked about, and this minimum tax on turnover, well, it explains why getting tax advisory support isn't really a luxury, it's almost a necessity.
Right.
The sources we looked at really emphasize that advisory firms are heavily involved in helping, especially foreign investors, navigate all this. Everything from incorporation, HR, obviously tax, like CIT, VAT, transfer pricing, and the legal compliance side, too.
Makes sense. Now, speaking of costs and maybe government control, the complexity seems to ramp up even more when we look at bringing goods into Bangladesh. Imports. This introduces something the sources call the total tax incidence, or TTI.
Yes, TTI.
It sounds like it's not just a simple customs fee. It's more like a stack of different taxes piled on top of each other.
That's a really good way to describe it. A stack. TTI is made up of 6 distinct layers that the importer of record, has to pay when the goods arrive.
6. Okay, what are they?
You've got customs duty, CD, then supplementary duty, SD again, then VAT, advance income tax, AIT, something called advance tax, AT, and finally regulatory duty.
CD, SD, VAT, AIT, ATRD.
Yeah.
6 taxes just to clear customs. Wow. Now, for cash flow purposes, which of those 6 can you actually get back later? Which are recoverable?
That's the crucial question for the importer. So 3 of the 6, the VAT, the AT, and the AIT, these are generally available later. You can claim them as an input tax credit or adjust them against your future tax liabilities. Think of them as sort of temporary cash outflows.
Okay.
Temporary. But the other 3, customs duty, CD, supplementary duty, SD, and regulatory duty, RD, those are not refundable. They become a final sunk cost that just gets added to the base cost of the imported product.
Right. Straight to the bottom line or passed on to the customer. And I gather the government doesn't just rely on the commercial invoice you provide for valuation. That seems like another compliance risk area.
Exactly right. The
Yeah.
primary method, yes, is the transaction value from the invoice. But the rules have a strict hierarchy if that value seems questionable, like maybe it's a transaction between related companies.
Transfer pricing concerns.
Precisely. So if the transaction value isn't accepted, you must follow a sequence. First, try to use the value identical goods imported around the same time. If that doesn't work, then similar goods. Only after exhausting those can you move to other methods like deductive value or computed value.
It's very systematic, clearly designed to counter any potential undervaluation at the border.
Definitely. It's about protecting the tax base at the point of import.
Okay, let's shift now from imports to a much more specific tax excise duty. This isn't like VAT applied broadly. Our sources suggest it's only imposed on, two specific service industries. And under a really old-sounding law, the Excise and Salt Act of 1944.
Yeah, it's very targeted, you're right. Just two main areas, banks and financial institutions, and airlines.
Okay, how does it work for them?
For banks, the duty depends on the account balance. It ranges from nothing for very small accounts up to BDT 50,000 per year for accounts holding over BDT 50 million.
Right, and for airlines.
For airlines, it's a duty charged per international ticket sold, and the amount varies depending on where the passenger is flying. It's lower for nearby SAARC countries, BDT 500, I think, and higher, BDT 3000, for places like Europe, the US, or basically the rest of the world. Diplomatic tickets are exempt, though.
Interesting. Another example of these micro-taxes layered on top for specific purposes, we also saw brief mentions of development surcharges, little 1% charges.
Yeah, those are quite specific, too.
Hmm.
Small 1% surcharges on things like mobile SIM cards, tobacco products often framed as a health surcharge there, and even cellular phones, sometimes called an ICT surcharge, often earmarked for particular social or environmental goals.
Okay. Which brings us, I think, towards the end here, capital gains and the day-to-day compliance stuff.
Exactly. Let's look at capital gains tax, CGT.
Right. Corporate CGT.
Huh.
Compared to VAT, it seems relatively simple, a flat 15% rate. But there are a couple of features that really matter for long-term investors, aren't there?
Yes, two key things. First, unlike in some other countries, there is no distinction made between short-term and long-term capital assets for companies. It's just 15%, regardless of how long you held the asset.
So, no tax incentive to hold assets longer.
Correct. But maybe more critically, there's no indexation of the cost base for corporate taxpayers.
Indexation, meaning they don't adjust the original purchase price for inflation.
Exactly. And given that many developing economies can experience significant inflation over time, failing to account for that means you end up taxing gains that are partly just inflation nominal gains, not real economic profit.
That lack of indexation could really inflate the actual tax burden when a company eventually sells an asset, couldn't it?
It certainly could, yes. It's a significant factor in calculating the real return on investment. And similar to the import valuation rules, the government has a say in the value used for the calculation.
How so?
The taxable amount isn't just based on what the buyer paid. It's based on the higher of either the actual sale price, the full value of consideration, or the fair market value, FMV, of the asset being transferred.
Always the higher value.
Yeah.
Again, that focus on fair market value seems like a recurring theme to prevent avoidance, especially in related party deals.
Absolutely. It's consistent with the approach we saw for imports. Protect the tax base using objective valuation where possible.
Okay, so finally, let's wrap up with the rhythm of compliance. What's the regular filing schedule that keeps accountants busy over there?
The main monthly grind revolves around the VAT return. It's called Mushak 9.1.
Mushek 9.1.
Got it. And that has to be filed by the 15th day of the month following the reporting month. So January's return is due February 15th.
Okay.
And tied to that, any VAT that was withheld at source, that BDS we talked about, also needs to be deposited by the 15th of the next month after making any adjustments for input tax credit the company might be eligible for.
And the admin burden isn't just filling out that one return form, is it? There's more record keeping involved. This is where those other Mushak forms come in.
Exactly. That's the difference between the return and the records. While Mushak 9.1 is the summary return you file, you're also legally required to maintain a whole series of detailed statutory registers. These are known as Mushak forms 6.1 through 6.8.
Wow, 6.1 through 6.8, what do they cover?
Pretty much everything. Your purchase records, sales invoices, credit notes, debit notes, VDS certificates received or issued. The real administrative weight, day to day, lies in accurately keeping those detailed statutory registers up to date.
Right. Given all this complexity, it's probably no surprise the government seems to be pushing hard for digitization to help enforce it all.
Oh, absolutely. That's a clear trend. The authorities have actually mandated that any VAT-registered business with sales turnover hitting BDT 50 million or more in the previous year must use specific board-approved accounting software.
Must use, not optional.
Not optional, mandatory. And failure to comply with that software requirement carries quite a hefty penalty, anywhere from BDT 10,000 up to BDT 100,000.
Okay, so they're serious about digital adoption. And the uncertainty for companies doesn't end once the return is filed, right? What about audits?
No, The risk exposure continues. Tax authorities have the power to initiate audits or assessments for up to 5 years after the end of the relevant tax period.
5 years. That's a long time to potentially have things revisited.
It is. It creates a long-term contingent risk on the books, although that window is a bit shorter, 3 years, for companies that are 100% export-oriented units, or EOUs.
Right.
But still, the penalties for getting things wrong, even if discovered later, are steep. You're looking at 1% interest per month for late VAT payments, and for late VDS payments, it's 2% interest calculated every 6 months, though capped at a maximum of 24 months worth of interest.
Okay, so bringing this all together, what does it really mean for someone operating in Bangladesh? It seems the core challenge isn't necessarily a crazy high corporate income tax rate itself,
No, not primarily.
but rather this incredibly detailed, multi-layered, and very strictly enforced system of indirect taxes, especially around VAT, withholding,